if someone said, like, the homeowner, they bought the house, they had a stable, job somewhere, they W-2 employee, but now they ventured into becoming a business owner and they're self-employed. How does that affect the lending process, or what should they look out for, or how long should they wait in order to move up to the new home since they've become a self-employed?
Yeah, it in general, if you go from being employed at, whatever you at Jack's Plumbing, and then you decide to become a self-employed plumber, and now you work for yourself. In general, we want to see 2 years of tax returns. We want to see 2 years of, because here's the thing, you may be the best plumber in the world, but how are you at running a business?
Mhm.
Right? Two very different things. And what the bank wants to know is, how are you at running a business? How are you at actually retaining money, right? Not blowing it all or having a problem, with running a business. So we like to see 2 years because it shows a consistency. So you made
Got it.
$100,000 in 2019, made $120,000 in 2020. Things are looking good for 2021. We're liking that. And we're going to say they make around $120,000 a year. And we have to look at tax returns. We have to look at W-2s. There's a few different documents that we need when we're talking about self-employed, whether they're a corporation, an LLC. I mean, there's different things that we have to look at. So we want to look at that closely. But we do have instances where people can do it after only 1 year. All right. So occasionally, depending on if they make a ton of money in 1 year, what if we just spread it out over 2 years?
Yeah.
And we divided their 1 year's income by 24 months and they still qualify. Right.
Okay.
So that's a potential. The guidelines that are put out by the banks and Fannie Mae and Freddie Mac, and that's part of the mortgage world, they're continuing to try to make lending easier and easier. So we're seeing a lot more requests for 1 year of tax returns. And normally what they used to say is you have to have been in business for 5 years before we'll use 1 year for the tax returns. Right. So, and the reason we did that is because let's say you had a terrible 2020. Let's say you had a great 2019, a terrible 2020, like lots of people did, right? 2021, you got back up. Well, hopefully we only need 2021 and we don't need to work in that tough year that was 2020. Right. So there's a lot of different ways that we can slice. Self-employed is just, it takes a little bit more analysis than obviously W-2.
With the income for the self-employed, do you guys base it off of their gross income or the net income that they actually had after deductions, after all the expenses for the business?
Yeah. So in general, I mean, there's a lot more to it, but in general, you have your gross sales, your gross, right? Which is, I went out, I sold $100,000 worth of donuts, right? And then you got to think about, well, how much did it cost for the mix and the batter and the electricity and all these different things. And at the end of the day, your $100,000 in sales, you show that you made $20,000 when it was all said and done. The bank is going to use $20,000 because when you think about it, you don't have $100,000. You need that $100,000 to operate your company. At the end of the day, you had $20,000. And that's the money that you could potentially use to pay your mortgage payment. And that's all the bank's worried about, is how much money do you have to pay your mortgage payment? If somebody says, well, I'm going to spend this $100,000 to pay my mortgage payment, well, guess what? You might go out of business because now you don't have any money to buy, your donut dough, So yes, it's going to be the net. Now we are able to add back certain items. So we go back and we look at the tax returns and we might say, well, you have $20,000 in net income, bottom line net income, but we're going to add back depreciation. We're going to add back, these one-time fees, like things like that. We can add back a few items and then we're able to maybe make that 20,000 into something more, 30,000, 40,000. Right. So we want to look at it a little bit more closely, but in general, we're using the net number. Now that's a very simplistic description of self-employed, because again, when you're talking about corporations, there's different types of corporations They might be getting dividends as well as W-2.
Right.
So, there's different things that we look at, which would be a conversation for another day.
Yeah.
I'll put up some videos that break all that stuff down for someone who just has a whole bunch of extra time on their hands and wants to learn about it. But, so yeah, that's what happens on self-employed.
Now, kind of like changing subject a little bit. Say for a homeowner took out a HELOC or a home equity line of credit on their house. They have a balance of 15 grand on that HELOC that they owe, and they want to sell. How does that work into the loan, or how would you guys look at that? Do they have to pay that off with, does that get paid off with the sale of the house, or how does that work?
So you have a home equity line of credit, which is a second mortgage. Okay, so home equity lines of credit are attached to the title of your home. So you have your first home loan, your main mortgage is with Wells Fargo. And then you have a home equity line of credit with, your credit union or whatever the case may be, because you needed $20,000 out to, fix your house up. And a lot of people do that because they'll fix their house up for sale. So they'll take out a home equity line for $50,000, for instance, redo the interior, redo the kitchen, get the house perfect, and then they sell it, right? But because the equity line is a mortgage, that the word mortgage like that is attached to the home. So you could not sell your house without paying off that equity line. It's just like the first mortgage. So they have a position on your house. They have a part of your title, so to speak. So they are, if you wanted to pay your house off and pay them off and sell your house, those things are going to have to be paid off out of the sale amount. All right. So you have $100,000 first mortgage, $20,000 second mortgage. You sell your house for $200,000. Well, you're going to have to pay out of that $200,000, $120,000 towards those two mortgages.
Okay. And now, say for example, the homeowner is now saying, okay, you know what? I'm going to sell this house. We're going to get another one. They've met with the realtor. They know how much money they're getting. Like, what things either in their income or in their credit they should avoid at this time, now that they're thinking about making this move, so that it doesn't affect them when the loan comes and then the underwriters are like, hey, you just did this. You should not be doing this. What are those things that they should look out for or avoid while they're going through this process?
Yeah. I mean, it's amazing how many things that we as, real estate professionals take for granted, that we would think that, oh, nobody would do that. But sometimes you do, you just aren't thinking about it. And surprisingly, what I've dealt with most recently is people just quitting their job.
Oh, wow.
Yeah. So it's like, and again, like maybe they quit entirely. Maybe they get, laid off, or there's all kinds of, reasons that they might do that, or they change employment. And changing employment in itself is not going to stop you from getting a loan. It's if you change industries or you do something that really alters what we can depend on for your income. So, again, if you're, working for, Fantastic Sam's, and then all of a sudden you become a plumber, like, that's different, so we're going to have to really look at that. But if you work for, Supercuts and then you go to Fantastic Sam's, you're probably going to be okay. All right. So those are things that we have to look at. Buying things on credit are a problem as well. Okay. So going out and deciding, well, I'm going to move and I'm moving, cross country, whatever, and I need a pickup truck. So I'm gonna go out and buy a truck, right? Like,
Yeah.
you got to be careful with that. You got to be careful with financing anything. A lot of I've seen people go out and buy all the furniture that they want for their new home on credit, and it shows up on their credit report before they even own the new home. Yeah, a matter of fact, I remember a time when I had to call somebody and say, look, either you return all that furniture, you got to return it. And I mean, you got to show that was returned, or you don't get your house.
Yeah.
I've had people go out and buy cars, right? And I go, well, now you don't qualify to buy a home. And that was like during escrow,
Oh my God.
So, you just want to be very careful making any moves. And the last thing, again, it's funny how when I'm going through here is income, credit, and now I'm going to go through assets. And that is moving money too much. be there before or during escrow. You can't just move money around. The banks want to know where all of your money came from. So what stops a lot of people is you can't have $20,000 in your safe and then go deposit it. Like, because the bank is going to say, where did that money
Where
come
they
from?
come from. Mhm.
Right. And they don't take, well, I saved it. Like they pretty much don't want to see a large cash deposit.
Yeah.
And a large cash deposit is 25% of your gross income. Okay, so if it's more than 25% of your gross income, it's a large deposit, and it must be not only explained but sourced. So all of a sudden we need like documentation. So I see a $15,000 deposit. Where did that money come from? Oh, well, I sold a car. Okay, well, show me the pink slip receipt, show me the bill of sale, show me something that the money came from somebody who we can actually say is a real person.
Right.
Right. So the banks are crazy about that stuff. You know, they want to know right where that money came from. So I would say moving money, moving money not in the proper way. And you just need to talk to your lender about the right ways. So I really need to know, everyone's scenario is different.
Mhm.
Since someone's getting a gift, someone is selling their house, someone else is not selling their house. Hero loans are
Yeah.
liens. Okay. So if you went out and you got a hero loan on your house at any time, so you put, solar, windows, AC, flooring, anything having to do with a hero loan, especially in Southern California, that was very popular for a while. You cannot finance a home with a hero loan. So not FHA, not VA, not conventional. So what that means is that your buyer cannot finance that property. If you're trying to sell your house, your buyer won't be able to finance that property. So you need to work that into your numbers when you talk about what are my proceeds going to be, my net proceeds. And that's where Zahira comes in. She'll figure that out for you.
Oh yes, definitely. We've had many instances. I
Oh,
had
yeah.
one instance. I had one instance of this lady. We were selling her house, and she had a hero loan of $80,000.
Mm.
It was about $80,000. She had no clue it was still there. The worst part, it was like you said, back in those days when all that was very, some unscrupulous companies took advantage of the whole solar thing, and
Yeah.
they didn't even end up doing all the work. Like she said, she never got the solar panels. They
Mm.
did the roof, but they never got the solar panels. She got the paint, that cool paint that they put outside the house. And there were the windows, I think they were done, but they never had the solar panels installed, nothing. So half of the work that they said that was going to be done, they never got done. And
Yeah.
when she sold the house, she still had to pay off that lien because it
Yeah.
was on her title. It was really sad situation. But yeah, now, is there anything else that, homeowners should look out for when trying to finance for their next home that you can think of that we haven't covered?
Yeah. I mean, it's one of those things where I could go on and on, right? I mean, there's so many things. So it's just very dependent on the individual situation. It's very important that you call and you talk to myself or another mortgage professional, because you really are missing half of the picture. If you don't have your financing in line. So you can go out and you can, imagine people that go out and they don't do that first, and they get their house in escrow, and they, are looking for another house, and in 30 days they have to be out, and then they find out you don't qualify for a home loan, maybe
Yeah.
for a reason that is we just can't get around, like it's just a hard no for one reason or another. Well, if you know that now, then you're going to be fine. Right? You stay in your house and you try to figure that
You
out.
don't
You
do
try
that.
to solve that problem. If you wait, then we may not be able to solve that problem fast enough for you. So
Right.
I would just say make sure that you reach out to that mortgage professional and have them look it all over. Get some numbers, get a pre-approval in your hands, and all of that before you move too far forward. And you may be pleasantly surprised at what we can do. The other thing too is monthly payments, they change.
Yeah.
So you may think that your payment's going to be $3,000 a month, and you talk to the mortgage professional and we're talking $3,800. Like something could have changed. Property taxes make a big difference. Interest rates move.
Yeah.
So you want to stay in touch with someone because you really need to know what your payment is going to be on this new property and what you can qualify for before you get real serious about, painting and repairing and boxing and all that kind of stuff. So if you do things in order, it's a lot less stressful.
Yeah.
So you really have to just lean on the professionals that are helping you out, let them walk you down the path. And I think it'll be a lot more comfortable for everyone.
Awesome. Well, great information. This is all, I mean, I know that we could go on and on and on with so many details because nothing is always the same. You always have that thing, it depends. It depends. You're always saying, well,
Yeah.
it depends. It depends on every single circumstance. But thank you so much for taking your time to be here and doing this with me. If someone wants to reach out to you and ask questions or try to get qualified for a loan, where can they reach you?
Well, you can email me directly, Brent@myranchocapital.com. So Brent@myranchocapital.com, or give us a call. Our mainline number is 866-222-0626. And my office will take your call, find out what you're looking to do, and then schedule a time for you to talk with me or one of my team. Probably you can just talk directly to me and I can look exactly at what you have going on, do a consultation. There's no cost, there's no obligation, but we just want to make sure that you know the real story. Don't just go online and think you're going to figure it out. Let us help you with really where you are. And then you're going to just be in so much better of a position to make an educated move.
Awesome. Well, thank you so much, Brent, for your time. I really appreciate you, and I'll talk to you soon.
Thank you for having me.
Bye-bye.